I've spent the last 30 years as an activist investor building some of the most successful concentrated positions in the history of hedge funds. I turned a $27 million investment in Canadian Pacific into a $4 billion profit in just 4 years. I made over $2 billion on a single trade betting against the bond market during COVID. And I've consistently delivered returns that make traditional real estate investing look like leaving your money in a savings account. Today, I'm going to explain exactly why I focus on stocks instead of real estate, and why you should too if you're serious about building generational wealth. Now, let me be very direct with you. Most people invest in real estate for all the wrong reasons. They invest in real estate because it feels safe, because their parents told them to, because they can see it and touch it, because some guru promised them passive income. But feelings aren't facts. And the facts, when you analyze them rigorously, show that concentrated positions in high-quality stocks will generate dramatically superior returns compared to real estate, with less work, less stress, and more flexibility. I'm not talking about buying index funds and hoping for the best. I'm not talking about diversifying across 50 or 100 stocks and settling for mediocre returns. I'm talking about the strategy that has made me billions of dollars, identifying a small number of exceptional businesses with sustainable competitive advantages and talented management teams, and building large concentrated positions in those businesses. This is how you create life-changing wealth. This is how you compound capital at rates that real estate can never match. Let me start by explaining what I look for in a stock investment, because understanding my criteria will help you see why real estate doesn't measure up. When I'm considering an investment, I'm looking for several specific characteristics that indicate a business capable of compounding capital at high rates for extended periods. First, I want a business with a durable competitive advantage. I'm looking for companies that have something their competitors can't easily replicate. A powerful brand like Chipotle, a network effect like Netflix, regulatory barriers like pharmaceutical companies, high switching costs like business software companies. These competitive advantages, what Buffett calls moats, allow a company to earn high returns on invested capital year after year. Second, I want a business with a long runway for growth. I'm not interested in mature, slow growth businesses. I want companies that can grow revenues and earnings at double-digit rates for the next decade or longer. This growth is what creates enormous value for shareholders. Third, I want excellent management. I need to see a management team that is smart, ethical, and focused on creating shareholder value. Management that thinks like owners, not like employees collecting paychecks. Management that makes good capital allocation decisions and isn't afraid to make tough choices. Fourth, I want a business that I can understand deeply. I need to know how the company makes money, what drives customer decisions, what could disrupt the business, what the competitive dynamics look like. If I can't understand it, I won't invest in it, no matter how promising it looks. And finally, I want to buy at a valuation that makes sense. I'm not a value investor in the traditional sense. I'm willing to pay up for quality, but I need to see a clear path to generating strong returns from current valuation levels based on reasonable assumptions about future growth and profitability. When I find a business that meets all these criteria, I don't just buy a little bit. I build a position large enough to matter. Typically, somewhere between 5 and 25% of my portfolio, sometimes even more. This concentration is how you generate extraordinary returns. Diversification, despite what they teach you in business school, is a hedge against ignorance. If you know what you're doing, concentration makes far more sense. Now, let's compare this approach to real estate investing and see why stocks are superior across every dimension that matters. The first and most important advantage of stocks over real estate is the quality of the businesses you can own. With stocks, I can own pieces of the best businesses in the world. With real estate, you're stuck owning buildings, which are fundamentally commoditized assets that can't compound in the same way that great businesses compound. Let me give you a concrete example from my own portfolio. In 2012, I started building a position in Canadian Pacific Railway. This wasn't just any railroad. This was a railroad with significant operational inefficiencies that I believed could be fixed with the right management changes. The railroad had an operating ratio that's expenses as a percentage of revenue of around 80%. The best railroads were operating at 65%. That gap represented an enormous opportunity. I didn't just buy the stock. I launched a proxy fight to replace the CEO with Hunter Harrison, one of the greatest railroad operators in history. We won. Harrison took over and transformed the operations. Within 4 years, the operating ratio improved dramatically, earnings more than doubled, and the stock price quintupled. My $27 million initial investment turned into over $1 billion of profit for Pershing Square. Could you achieve anything remotely similar with real estate? Absolutely not. Real estate doesn't have that kind of operational leverage. You can't buy an apartment building, bring in world-class management, and quintuple the value in 4 years. The economics don't work that way. Buildings are fundamentally limited in how much value they can create. You collect rent, you maintain the property. Maybe you can improve operations slightly to increase occupancy or reduce costs. But you're not going to see dramatic transformations that create multiples of your invested capital. Real estate is a low return, slow growth asset class. Stocks in great businesses with catalysts for improvement can generate returns that real estate investors can't even imagine. Here's another example. During the COVID pandemic in March of 2020, I saw that credit spreads were blowing out dramatically as panic hit the markets. I put on a massive short position in credit default swaps, essentially betting that corporate bonds were going to get hammered as the economy shut down. Within weeks, I turned a $27 million investment into $2.6 billion of profit. That's a nearly 100 times return in 1 month. That kind of asymmetric return profile simply doesn't exist in real estate. Even in the most extreme situations, even if you perfectly time the bottom of a real estate crash and buy properties for 50 cents on the dollar, you might double or triple your money over several years. You're not going to see 100-fold returns in a month. The opportunity set is completely different. The second major advantage of stocks is what I call operational leverage. Great businesses have the ability to grow earnings much faster than they grow revenues because of fixed cost leverage and operating leverage. Real estate has no comparable characteristic. Let me explain how this works with a specific example. Take a company like Netflix. They create content, which is a fixed cost. Once they've spent the money to produce a show, it costs them almost nothing to stream that show to one additional subscriber. So as they add subscribers, the incremental profit margin is extremely high. They might spend $10 billion on content and generate $30 billion in revenue from 100 million subscribers. If they grow to 200 million subscribers, they don't need to double their content spending. They might increase it by 50% to $150 billion, but revenue doubles to $60 billion. The incremental margins are huge. This is operational leverage, and it's incredibly powerful for compounding capital. Companies with high operational leverage can grow earnings at 2 or 3 times the rate of revenue growth. This creates enormous value for shareholders. Real estate has the opposite characteristic. Real estate has what I call negative operating leverage. As your rental revenue grows, your costs tend to grow just as fast or faster. Property taxes are often based on assessed values, which rise with market values. Insurance costs rise, maintenance costs rise, labor costs rise. you're essentially running in place. There's no leverage that allows you to dramatically improve margins as you scale. In fact, real estate often has diseconomies of scale. Managing 10 properties is more than 10 times harder than managing one property because each property has its own unique issues, its own tenants, its own maintenance problems. You end up needing more staff, more systems, more overhead. The margins don't expand. They often compress. The third advantage is what I call capital velocity. This is the speed at which you can move capital from one opportunity to another. And this is absolutely critical for generating superior long-term returns. In the stock market, I can move capital instantly. If I identify a better opportunity, I can sell one position and buy another in seconds. The transaction costs are minimal, typically just a few basis points. This means I can constantly optimize my portfolio, moving capital to the most attractive opportunities as they present themselves. Let me give you a real example of how powerful this is. In 2023, I decided that the risk reward on some of my positions had changed. Interest rates were rising, which affected valuations. Some businesses were facing headwinds. At the same time, I saw new opportunities in companies that were better positioned for the higher rate environment. I was able to restructure significant portions of the portfolio within days. I exited positions that no longer met my criteria and built new positions in more attractive opportunities. This flexibility allowed me to adapt to changing conditions and position the portfolio for superior returns going forward. Try doing that with real estate. If you decide that your rental properties are no longer the best use of your capital, you're looking at months to sell them. You need to find buyers, negotiate terms, go through inspections, deal with financing contingencies. The whole process might take 6 months or longer, and you're paying 5 to 6% in real estate commissions, plus closing costs, plus capital gains taxes. During those 6 months, market conditions might change. The opportunity you wanted to pursue might disappear. Your capital is trapped, earning suboptimal returns while you wait for the transaction to close. This lack of capital velocity is a massive handicap that compounds over time. Think about it this way. If you can optimize your portfolio twice per year, moving capital from opportunities generating 10% returns to opportunities generating 15% returns, that 5 percentage point difference compounds enormously over decades. The investor with high capital velocity will dramatically outperform the investor whose capital is trapped in illiquid real estate. The fourth advantage is the ability to use leverage intelligently and strategically. Now, I know what you're thinking. Real estate investors love to talk about how easy it is to use leverage in real estate. You can buy a property with 20% down and finance 80%. True. But this is actually a disadvantage disguised as an advantage. Real estate leverage is what I call dumb leverage. It's a fixed obligation that you have to service every month regardless of circumstances. If you have a mortgage, you have to make that payment, whether or not you have tenants, whether or not the property is generating cash flow, whether or not the property has declined in value. This leverage is inflexible and creates fragility. With stocks, you can use what I call smart leverage. You can use options to create leverage with limited downside. You can use margin selectively when opportunities are particularly attractive and pay it down when they're not. You have complete flexibility to adjust your leverage based on market conditions and opportunity sets. At Pershing Square, we've used leverage strategically to amplify returns when we have high conviction in specific situations. But we maintain the flexibility to reduce or eliminate that leverage if conditions change. This flexibility is enormously valuable, and it's something real estate doesn't offer. Moreover, the leverage that's available in real estate creates a systematic problem that makes real estate less attractive as an asset class. Because leverage is so readily available, buyers bid up property prices to levels that reflect leveraged returns rather than unleveraged returns. In other words, property prices are inflated by the availability of leverage, which means unleveraged real estate returns are compressed. You see this very clearly in cap rate compression over the past 15 years. As interest rates fell and leverage became cheaper, cap rates on real estate compressed from 8 or 9% down to 4 or 5% in many markets. Property prices rose not because the fundamentals improved, but because buyers could afford to pay more using cheap leverage. This creates a trap for real estate investors. The only way to generate decent returns is to use leverage. But using leverage creates fragility and risk. You're forced to take on risk just to generate mediocre returns. With stocks, you can generate excellent returns without leverage by selecting the right businesses. The fifth advantage is transparency and information flow. In the stock market, especially with large public companies, there's enormous transparency. Companies file detailed quarterly and annual reports. They hold earnings calls where management discusses results and answers questions. There are teams of analysts covering every major company, publishing research and estimates. The amount of information available is staggering. This transparency allows me to make informed decisions. I can analyze financial statements in detail. I can compare companies within an industry. I can track key metrics over time. I can see exactly how much debt a company has, what their cash flow looks like, what their return on invested capital is. This information advantage is critical for successful investing. Real estate is opaque by comparison. When you're looking at buying a property, you get some basic information, the seller's financial statements, if they're willing to share them, which often aren't audited or reliable, maybe an appraisal, maybe a property inspection, but you're largely flying blind compared to what you get with public stocks. You don't know what comparable properties are really selling for because real estate transactions aren't fully transparent. You don't know what rental rates are truly achievable because landlords often provide misleading information. You don't know what the true condition of the property is until you own it and problems start appearing. This lack of transparency creates information asymmetry that favors sellers over buyers. In the stock market, information asymmetry still exists, but it's much smaller. This is actually an advantage for sophisticated investors like me because I can use my analytical capabilities to extract insights from public information that other investors miss. But I can't do that if the information doesn't exist at all, which is often the case with real estate. The sixth advantage is the ability to influence outcomes. This is something I'm particularly passionate about because activist investing has been central to my success. When I buy a significant position in a public company, I can engage with management, propose strategic changes, push for operational improvements, or if necessary, launch a proxy fight to change the board and management. At Canadian Pacific, I didn't just buy the stock and hope management would improve operations. I actively drove change by replacing the CEO. At Chipotle, where I built a large position, I worked with management on strategic initiatives to improve operations and drive growth. This ability to influence outcomes is incredibly powerful, and it's something that only exists with stocks and public companies. With real estate, you have no such ability. You can improve the specific property you own. Sure, you can renovate it, improve management, raise rents where possible, but you can't influence the broader market dynamics, the local economy, demographic trends, competing properties. You're a price taker, not a price maker. This lack of agency is frustrating and limiting. I don't want to be passive. I want to actively create value. Stocks give me that opportunity. Real estate doesn't, unless you're operating at such a massive scale that you're effectively developing entire neighborhoods, which is not what we're talking about for individual investors. The seventh advantage is tax efficiency and the ability to optimize tax outcomes. Now, real estate investors love to talk about depreciation deductions and 1031 exchanges. These are legitimate tax benefits, but they're nowhere near as powerful as the tax strategies available with stocks. First, with stocks, you have complete control over when you realize gains. If you're in a high-income year, you can defer selling winners and perhaps harvest some losses to offset other gains. If you're in a low-income year, you can strategically realize gains when your tax rate is lower. This flexibility is enormously valuable over a lifetime of investing. Second, you can donate appreciated stock to charity and get a deduction for the full market value while avoiding capital gains tax entirely. I've done this extensively, donating billions of dollars of appreciated stock to my foundation. This is a far more efficient way to be philanthropic than donating cash. Third, if you hold stocks until death, your heirs get a stepped-up basis, and the capital gains tax is eliminated entirely. This is an enormous benefit for generational wealth transfer that real estate also has. So it's a wash there. But here's what real estate doesn't have. With stocks, you don't have to pay property taxes every single year. Property taxes are a drag on returns that compounds over time. In high-tax jurisdictions like New York or California, property taxes can be 1 to 2% of property value annually. Over 30 years, that's 30 to 60% of your initial investment gone to taxes. And that's not even counting the capital gains taxes when you sell. The eighth advantage is the quality of life factor. This is something that people dramatically underestimate when comparing stocks to real estate. Real estate investing, unless you're operating at institutional scale with professional management, is a second job. It requires ongoing time and attention. Stocks, once you've done the initial analysis and made the investment, require minimal ongoing attention. Let me be very clear about this. I don't want to spend my time dealing with tenant problems, maintenance issues, property managers, or any of the operational headaches that come with owning real estate. My time is valuable. Every hour I spend on managing properties is an hour I'm not spending on finding the next great investment opportunity or building my business or spending time with my family. When I own stocks in great businesses, the management teams of those businesses wake up every morning thinking about how to create value. The CEO of Chipotle isn't calling me to fix a broken refrigerator. The management team at Netflix isn't asking me to approve a marketing campaign. They're doing their jobs, and I'm free to do mine. This leverage of other people's talent and effort is one of the most underappreciated aspects of stock investing. You're essentially hiring some of the best business operators in the world to work for you, and you're doing it at a tiny fraction of what it would cost to hire them directly. Now, let me address the common objections that real estate investors raise, because I want to be thorough and fair. The first objection is that real estate provides stable cash flow through rental income. This is true to some extent, though the stability is overstated. Vacancies happen. Tenants stop paying rent. Major repairs are needed. The cash flow is much lumpier than people expect, but more importantly, I don't invest for current cash flow. I invest for total return. A stock that pays a 2% dividend but grows at 20% per year is giving me a 22% total return. I'll take that over a rental property yielding 6% with 3% growth any day of the week. And if I need cash flow, I can create it from stocks by selling small amounts periodically. This is actually more tax efficient than rental income, which is taxed as ordinary income. Long-term capital gains from selling stocks are taxed at lower rates. The second objection is that real estate is tangible and you can see it. This psychological comfort is actually a weakness, not a strength. The tangibility creates an illusion of safety that causes investors to underestimate risk and overestimate returns. I don't need to see my investments. I need my investments to compound capital at high rates. Whether I can touch them is irrelevant. This is emotion masquerading as analysis, and emotion is the enemy of good investment decisions. The third objection is that real estate provides inflation protection. So do stocks in great businesses, usually better inflation protection than real estate. Companies with pricing power can raise prices faster than inflation. Companies with high returns on invested capital can grow earnings faster than inflation. Real estate is actually quite vulnerable to inflation, especially when inflation is accompanied by rising interest rates, which compresses property values even as operating costs rise. The fourth objection is that you can use leverage more easily with real estate. I've already addressed this, but let me emphasize the point again. Easy access to leverage isn't an advantage. It's a temptation that causes most investors to take on more risk than they should. The fact that banks will lend you 80% of the purchase price doesn't mean you should borrow that much. No. Let me share my specific approach for how to invest in stocks successfully, because understanding why stocks are superior is only valuable if you know how to execute the strategy properly. First, focus on a small number of high-quality businesses. I typically have between 6 and 12 positions in the Pershing Square portfolio. This is enough diversification to protect against any single mistake destroying you, but concentrated enough that your best ideas really matter to your overall returns. Most investors over-diversify. They own 30 or 50 or 100 stocks because they don't know what they're doing and they're trying to hedge against their ignorance. This guarantees mediocre returns. If you do the work to truly understand businesses, you should concentrate your capital in your best ideas. Second, do deep fundamental research before investing. I'm talking about reading every financial statement, understanding every aspect of the business model, analyzing the competitive dynamics, studying the management team, modeling out different scenarios for how the business might evolve. This is hard work. It takes time, but it's what separates successful investors from unsuccessful ones. I spend months researching a business before I invest. I talk to competitors, customers, suppliers, former employees. I visit facilities. I read everything I can find about the industry. By the time I make an investment decision, I understand that business as well as or better than management does. Third, look for catalysts that will unlock value. I'm not a buy and hold forever investor like Buffett. I'm looking for situations where there's a clear catalyst that will cause the market to recognize the value that I see. That might be a change in management, a strategic shift, an operational improvement, a spin-off, or a market realization of underappreciated assets. At Canadian Pacific, the catalyst was bringing in Hunter Harrison to fix operations. At Chipotle, the catalyst was rebuilding the brand after food safety issues and implementing new operational practices. At Hilton, which was another successful investment, the catalyst was the company's shift to an asset-light model and the growth of their loyalty program. Fourth, size your positions based on conviction and risk. My largest positions are the ones where I have the highest conviction and where I believe the downside is limited. I might put 20 or 25% of the portfolio into an idea where I'm highly confident. For ideas where I'm less certain or where the risk is higher, I might only allocate 5 or 10%. This is very different from the equal weight approach that many investors use. Equal weighting makes no sense. Why would you put the same amount of capital in your 10th best idea as in your best idea? You should bet big when you have an edge and bet small when you're less certain. Fifth, be willing to hold positions for years if the thesis is playing out. One mistake that activist investors sometimes make is being too impatient. If you've identified a great business with a long runway for growth and value creation, you should hold it as long as that thesis remains intact, even if it takes years to fully play out. My investment in Chipotle is a good example. I started building the position in 2016, and I still own it today, over 7 years later. The position has generated enormous returns because I had the patience to let the thesis play out over an extended period. Sixth, Cut losses quickly when you're wrong. Despite all the research and analysis, sometimes you're going to be wrong. When that happens, acknowledge it quickly and move on. Don't average down into a losing position hoping it will recover. Don't hold on to losers because you're embarrassed to admit a mistake. Cut the loss, learn from it, and redeploy the capital into better opportunities. Seventh, use options strategically to enhance returns or reduce risk. Options are a tool that real estate investors don't have access to, and they can be incredibly powerful when used correctly. I've used long-dated call options to create leverage with limited downside. I've used put options to protect against tail risks. I've sold calls against positions to generate income. Options provide flexibility that can significantly enhance risk-adjusted returns. Now, let me give you a concrete example of how this approach generates superior returns compared to real estate. Let's say you have $1 million to invest. If you put that into rental real estate, you might buy 2 or 3 properties using leverage. After accounting for all the costs, friction, and time investment, you might generate 8 to 10% annual returns if you're successful. Over 20 years at 9%, your $1 million becomes $5.6 million. Not bad, but let me show you what's possible with concentrated stock investing. In my career at Pershing Square, we've generated average annual returns of around 16% since inception in 2004. Some years have been much higher, some lower, but 16% is a reasonable long-term expectation for a concentrated portfolio of high-quality stocks when you do the work properly. At 16% annual returns, your $1 million becomes $20 million in 20 years. That's nearly 4 times the outcome from real estate. And you achieve it with less work, less stress, better liquidity, and more flexibility. But it gets even better. Because you have better liquidity with stocks, you can take advantage of opportunities that arise during market dislocations. During the COVID crash in March 2020, stocks fell 30 to 40% in a matter of weeks. If you had capital available and the courage to invest at that moment, you could have made 2 or 3 years' worth of returns in a few months. Real estate investors couldn't take advantage of that opportunity because their capital was locked up in properties. Even if they wanted to buy stocks at distressed prices, they couldn't because selling real estate takes months. This flexibility to respond to opportunities is incredibly valuable, and it compounds over time. Let me be very clear about something important. This approach is not for everyone. Concentrated stock investing requires skill, discipline, and emotional fortitude. You need to be able to do rigorous research. You need to think independently and go against the crowd when necessary. You need to maintain conviction during periods of volatility when your positions are down 20 or 30%. You need to manage your emotions and avoid the behavioral mistakes that destroy most investors. If you can't do these things, if you're going to panic and sell during downturns, if you're going to chase hot stocks and sell your winners too early, then maybe index funds or even real estate are better for you. But if you're willing to do the work, if you can maintain discipline, if you can think long-term, concentrated stock investing will generate dramatically superior returns. Let me also address the scale question, because some people argue that this approach only works with large amounts of capital. That's completely wrong. In fact, concentrated stock investing actually works better with smaller amounts of capital because you have more opportunities available to you. When I'm investing billions of dollars, I'm limited to large cap stocks because I need enough liquidity to build meaningful positions without moving the market. But if you're investing hundreds of thousands or even millions of dollars, you can invest in small and mid-cap stocks where the opportunities are often better. You have an advantage that I don't have. Some of the best returns I generated in my career were in the early days of my fund when I was managing smaller amounts of capital and could invest in smaller companies. As you scale up, the opportunity set narrows, which is why it's actually easier to generate high returns with smaller amounts of capital if you know what you're doing. I've been investing for 30 years now. I've managed billions of dollars. I've made mistakes and learned from them. I've had spectacular successes and painful failures. And through all of that, one thing has remained constant. Concentrated positions in high-quality stocks have generated dramatically superior returns compared to real estate or any other asset class. The math is simple. Higher expected returns from owning great businesses, lower friction costs from better liquidity, better capital velocity from being able to move money quickly, the ability to use leverage intelligently rather than being forced into dumb leverage, superior tax efficiency, and a much better quality of life because you're not spending your time managing properties. Real estate might feel safer. It might be what your parents did. It might be what all your friends are doing. But feelings aren't facts. The facts, when you analyze them rigorously, show that concentrated stock investing is the superior path to building generational wealth. Focus on quality businesses with durable competitive advantages. Do the research to truly understand what you own. Build concentrated positions in your best ideas. Have the patience to let your winners run. And have the discipline to cut your losers. That's the formula. It's worked for me, and it will work for you if you execute it properly. The opportunity is there. The question is whether you have the skill and discipline to seize it. Stop wasting time on real estate. Start building concentrated positions in great businesses. That's how you create real wealth.